Hey everyone, hope everybody is doing well. It is Thursday after the market closed about 5:30 in the afternoon. And of course, I'm Sam Rodriguez. I'm here with Brian Krukiel. We really wanted to revisit that wall of worry that we talked about with you last week. There's obviously been a lot of developments since the chaos of the markets last week. There's been a lot happening. So we wanted to touch on each one of those again and let you know what developments have taken place since then. So, Brian, let's start off with what August looks like historically and what we're seeing right now.
Yeah, sure. Thanks, Sam. So first of all, the seasonality thing, right? So traditionally, August through October are just bumpier times of the year for markets, and so obviously that's proven to be true. But what's interesting is if you go back since 1950, the majority the majority of those seasonal tough periods occurred during August. And then what's interesting is the majority of them the first couple of weeks of August. In fact, it's like 15 out of 74 years, the bottom, in terms of this volatile time period of markets has happened the first week of August. So that's really reason for us to believe that, those lows could be behind us.
So last week when everything started falling, what really kicked it off was this July jobs report, right? So what have we learned about that jobs report since then?
Yeah, so the concern is that the jobs, and you can see that this is essentially the Federal Reserve's kind of initial claims chart going back over time. So and this yellow line here at the top is what that report was and when it came in, and so you can see that it's higher than previous months' reports, previous months' data, and the concern, the market's concern with that was that economic activity, particularly jobs, ultimately the consumer, is starting to spill over and weaken, and that's really concerning. But what we've since seen is we've received some more economic data as it relates to jobless claims, and we've seen that come back in, which is essentially kind of what we anticipated. In fact, when you look at Texas by itself, you can see a huge spike, and this is exclusive of Texas. Ultimately, a lot of that had to do with Hurricane Beryl. We saw the spike. Things appear to have settled back down, and that's good, right? So I believe that we can take that jobs print and call it noise at this point.
Yeah.
And I think the narrative that should continue is that we should see economic data slowly start to unwind. Which is as expected. Things should start to weaken a little bit since the tighter economic policies, but things don't necessarily, and they shouldn't, fall off a cliff all of a sudden, and we're not seeing that. And so this is just kind of evidence of that being true.
So another big thing in the news was this Japan carry trade. Before you really dive into what's happened since that initially hit the news, can you just really quickly and simply explain what that carry trade means? Because we've been getting a lot of questions about it.
So at the end of the day, what the whole Japanese carry trade is that, like, the yen, Japanese currency, has been weakening significantly. Simultaneously, the U.S. dollar has been strengthening. And so if you can borrow money and have a really low interest rate and put it somewhere else where interest rates are higher, you create this positive arbitrage, right? And that's what a lot of traders and investors have been doing for actually several years. And so here, as of late, we saw the Bank of Japan increase their interest rates. Simultaneously, U.S. rates are starting to drift downwards. And so that really starts to unwind that. So people are taking their money from the U.S. and moving it back over to Japan, ultimately causing this volatility in markets.
Do we feel like it's mostly over right now?
We do. So first of all, we had essentially the chairman of the Bank of Japan's, Fed equivalent, come out and tell us that they're not going to rise, they're not going to hike interest rates, cause market instability. So they're aware of this. They have every intention of continuing to keep markets stable. And a lot of that was unwound. So we think that the majority of that unwind is over, and that, the action that took place looks to have been, a ripping off the Band-Aid effect, for lack of a better term.
The Middle East has obviously been in the news for months. What's happened recently that it's causing even more of a concern?
Yeah, so at the end of the day, it's just more volatility in the Middle East, particularly with Hamas, Israel, and even Iran coming into the mix. And honestly, this is still a concern. Although there's a lot of interest globally, in finding, creating a ceasefire, working towards peace. There's peace talks occurring today, although Hamas is not attending. But this is definitely something that we're paying close attention to. We think that, is gonna add some fuel to the fire here in markets. Going to continue to. But I think importantly, any negative market reactions from this should be mostly short-term in nature. There's a lot of motivation and incentives to keep things calm. And I think really what's driving markets, it's more, Fed policy and, economic strength or weakness, right? Is really what's driving things and should be driving things. We are paying attention to, still a concern, but it appears that there's a lot of effort, to work towards a peaceful solution.
Over the last few years, the Magnificent Seven, right? Google, Amazon, Facebook, companies like that have really driven the prices in the market, right? What's happening with those 7 stocks in particular, and what are we seeing in the rest of the market right now?
Sure. Well, I think even more than just the Mag 7, we're really seeing this broadening out trade occur. And that's really where, traders, investors, money managers are taking, their exposure they have to these more expensive large cap stocks, and creating positions in other parts of the stock market across, asset classes and companies that maybe haven't performed as well. And so that's the whole broadening out theme. And we continue to see that happening. And it's actually a positive thing. We need it to happen. I think thin or narrow market leadership is not necessarily the sign of a super healthy market. And so, this really what we're seeing is we've gotten a lot of data this week, and this data is telling us that, retail sales came in strong. And we saw some lighter than expected jobless claims. And so that's really good. That kind of sets the stage for, this broadening out theme to continue. And we've also seen a pretty resilient market. Almost 100% of the S&P 500 has reported their quarterly earnings report, and overall, almost 80% are beating their earnings estimate. So all that to say, we continue to see this broadening out trade occur. I think it's a good thing. But to say, I don't necessarily think we're going to see tech fall off a cliff completely, and we're seeing a lot of support there too.
I really see this as more of confirmation that not just the market, but that the economy as a whole is healthy, when we're starting to see the other 493 US-based companies are very, very profitable at this point and doing really well. So obviously we're in an election year. Election years always tend to be choppy. What are you seeing right now with what's going on?
Yeah, well, I think a couple of weeks back, when this was I guess one of the things that caught markets off guard, I think the markets digested it, and ultimately where we go from here is I think that these political talks are going to continue to add choppiness to markets. Markets prefer certainty, and so I suspect that this is going to continue, right? We're in an election year, but I do believe that most of this will be noise. Again, just to reiterate, I think the driving factor of markets is going to be the consumer, the health of the consumer, economic data here in the U.S., and policy decisions that are going to be driven by the Fed. Political conversations are going to be a little bit more noise.
Let's wrap this up with what we're still looking at and what we think people should be considering moving forward.
Sure. I think broadly, Sam, I think that stocks have the runway and the economic backdrop to perform reasonably well during the second half of the year. Bonds also look pretty attractive, particularly like shorter duration bonds, but I think it's got to require some attention with regard to where you are positioned on the yield curve. I think that the dilemma with the Fed and the policy is that if the Fed waits too long to move rates or doesn't move rates enough, a recession is going to be more likely. However, if they start talking and acting and actually moving rates pretty quickly, I think that things could be in reasonably decent shape, and I think that that's ultimately what we hope to see, and it looks like it looks like we're likely going to see that happen. The key thing to watch is the consumer. The consumer, when I say this is the average American, right? The average American is struggling a little bit, but they're maintaining, and this is important. Consumption is 70% of our economy, and so lower rates are going to help this. Hence why there's so much focus on jobs data. It's very, very important information to pay attention to right now. And so here's some important dates that I think all should pay attention to, and we're paying attention to as they get closer, is that there's a Jackson Hole Economic Symposium, and Powell is going to be speaking there, and this is late August. Also, towards the end of August, we're going to have July's PCE, and this is the Fed's preferred measure of inflation. So that's going to be some important information to look at for. And then early September, looking into August, August is jobs data. This is going to be some important telling information about the consumer and where the jobs marking is trending and how fast that trend is occurring.
Yeah, so I'd say all in all, from that August jobs report, right, we expect it to be better than July, right? The July report that kicked off all the volatility. And then as far as the Fed dropping rates quickly enough, they've really already hinted that they're going to start dropping rates as early as next month. And I think that Jackson Hole meeting and the July PCE report should really confirm that, right?
I believe that'll be the case, Sam. Still a lot to unpack, but
no, I need a prediction from you. Just kidding. Just kidding. So,
right.
So all in all, it looks like economically we're in pretty good shape. Looks like anything that we see in terms of volatility here in the near term really is going to be short-term noise.
I believe that to be the case, Sam.
All right. Well, guys, we really appreciate you watching. Of course, as things develop, we'll try to be communicative with you, let you know what you should be paying attention to, what we're thinking about it, what we're doing about it. And if you have any questions, whoever your advisor is here at Foundation Wealth, feel free to reach out to them. Let us know if there's anything you want us to talk about and you want to hear what we're thinking about. All right, guys. Thanks a lot. Thanks, Brian.